Welcome, listeners, to the latest episode of Future Secured. And today we're sitting down with Michael Gianarakis, co founder of Assetnote and now Chief Product Officer at Searchlight Cyber, following Assetnote's 2025 acquisition. Now, Michael's had over 17 years at the front line of offensive security, and as a frequent speaker at DEFCON, BSides, Hack in the Box, Michael brings a rare perspective on building cybersecurity products that matter. From bootstrapping a startup in Australia to leading enterprise product strategy, Michael today is going to hopefully share some great lessons on scaling technology, shaping industry narratives, and why security products he thinks they often miss the mark. It's going to be an interesting chat. So thank you for joining us, Michael. Thank you for joining us, as always, co-host Jason. And over to you, Jason, for our first question.
Thanks, Tony. And yeah, thanks for joining us, Michael. It's always good to have someone who's gone through the startup journey on the pod and share the experiences that you have, because it's always an interesting journey. Can you just give our listeners just a bit of a background on sort of, maybe in whatever chronological order you like, in reverse order or from the beginning and upwards, how you sort of ended up where you are today?
Yeah, so I guess maybe it might be a bit easier to start from the beginning, but yeah, as Tom mentioned, I've been working in the industry for a while. You just reminded me of my age there a little bit, but yeah, no, I started out in offensive security, so pen testing, red teaming, things like that. Various roles, starting at sort of Big Four, and also various boutiques here in Australia. Prior to Assetnote, I ran the Spider Labs team for Trustwave for APAC. So there was a little bit more management overseeing, the offensive security team there across the APAC region, and then started Assetnote. So Assetnote, my co-founder Shubs and I, we started, wow, over 7 years ago now, and bootstrapped, which is an interesting choice, I guess. Not necessarily a strategic choice; it just sort of happened that way, but it worked out well for us. And yeah, we just decided. We saw a bit of a gap. We both came from the bug bounty space. I'm not sure if you're familiar with the bug bounty space, but I'd been involved. I was an early investor in BugCrowd. Shub's very prominent bug bounty hunter.
Yeah,
And
we had Casey Ellis on just before the RSA conference this year.
oh,
So
nice. Yeah,
yeah,
they've done
so
well.
we've they have done very well. Yeah.
Yeah, I mean, it was an interesting kind of idea. I mean, Shubs and I talk about this a lot, but we firmly believe a lot of the innovation in the offensive security space is actually now coming out of the bug bounty scene, as opposed
Mm.
to, I guess, traditionally it might have been out of these sort of corporate pen test technical consultancies. And so it's maybe a bit of a tangent, but we were both heavily involved in the scene, and the DNA of Assetnote and the beginnings of the product actually came from that scene, in the sense that Shubs had built just some tooling that was helping him, with these bounties, and it was helping him to be very effective. He shared it around with me and a couple of other folks, and we had a bunch of people from big companies basically come and say, hey, we spent all this money on pen testing, on source code review, on vulnerability scanners, and all these other tools. Yet you guys keep rinsing our bounty. How do you do it? And we'd explain the process and the tooling and the approach. And a bunch of them basically came and said, if you were selling this, we would buy it.
Mm.
And so that really got the wheel spinning, and we started to ideate on that. And yeah, took the plunge in 2018, and the rest is history. I mean, there's lots of ups and downs between them, but I'm sure we can go into the detail if you want. But yeah, the rest is history.
It's interesting you sort of said that, because that's an interesting part, and that's the part where a lot of startups make the mistake, where you sort of got almost pulled into it from customers saying, "We'd really love that," right? That's the thing, is that often people think they have a market fit and say, "Oh, well, we're just going to build this product and make it, and then put it in market," and there's no want for it. So it was good. You sort of, it sounds like, almost accidentally got dragged into the market by the fact that people said, "If that was a product, we would buy it." It's like, okay, let's make that product.
Yeah, definitely. There was definitely a sense of validation there, like initially. I mean, we
Mm.
had seen it ourselves, right? So we were consuming this, and we obviously understood there was value there. But the real trick was really understanding that there was also value for the defenders in applying it this way. And the genesis of Assetnote was really, how do we make what we've built here consumable for defenders? But yeah, definitely there was a sense of validation there. And when we started, we didn't take any investment. We just got it out to market as soon as possible, getting feedback and iterating as quickly as we could. And 100% agree with you. The notion of build it and they will come, I don't think really works. We didn't necessarily approach it in a super strategic way. I mean, we were bootstrapped, so we need to sell to get money. So it was very much in a certain sense built in public, but not necessarily public, but customers. And I think I hear a lot of startup founders today, and they talk about, oh, I've sent a survey around, or I've spoken to a whole bunch of different people, and they said they would buy it and whatever. And I would always ask the question is, how many of those are actual commercial discussions? How many are in the context of an actual sale? Because you're not going to get real feedback. So the sooner you can get in and start selling it to people, and every conversation that you have is really centered around this idea of you can buy this, we're going to sell it to you. The better the feedback's going to be, and the faster you can get to that kind of concept of product market fit.
Yeah, one of the questions we often ask when we're change founders, and I'd be interested with a benefit of hindsight view on this one. So you started it off bootstrapped. So the reasons for not taking investment, but also, did you have a view that you wanted to exit? Is it something that happened organically? Had you built that into the DNA of the company as you're going? And what really was that journey with Searchlight Cyber like?
Yeah, it's an interesting question. In terms of the decision to bootstrap it, again, it wasn't really strategic. The funny story is, when we first started Assetnote, we were writing down, what do we want to build and how do we want to build it, what's it going to be, and really defining the product. And I asked Shubs, I said, hey, should we maybe go chat to some investors, get some money, get a developer on board or two. And he was like, no, we can build this in like 6 weeks. It's fine. I will say that it took a lot longer than 6 weeks. But that was really the one and only discussion that we had around investment in the early days. And then as we started to build, we got approached by investors. I mean, we were approached by investors all the time. And the initial investors, and they were very large investors as well. We didn't really. There were multiple reasons why we didn't take it. The first one was Excel hit us up, so obviously a very big brand. Shubs hadn't really heard of them before, and we got on a meeting with them, and afterwards asked Shubs, what were your thoughts? What did you think? And he was like, I don't know, I just got Wolf of Wall Street vibes from these guys. So they're sort of that finance bro vibe. I'm like, they're VCs, man. Like that's what they're all like. And so we didn't really do that. And then a lot of the discussions that we had a lot of investors that hit us up that would recognize the traction. And we had a lot of, all of our early customers were gigantic companies, big deals. And we had a massive pipeline full of big logos, and so they would recognize the traction, but they never really got it. And a lot of the times they would come to us and say, "Oh, well, we'll give you this, and you hire this many people, and then you go Series A and you hire this many people." And at what point did we start talking about like product or sales or profitability or any of those sort of things? In terms of running a business, it just wasn't even part of the discussion. And we kind of felt what we tried to do ultimately was maximize for optionality. In the sense of, if we built a profitable, sustainable, growing business, then we would always have optionality. We'd always have investors that were interested. We'd have acquirers that were interested. And, we could just keep running it ourselves, if it was in that state. So, going down the VC path felt a little bit all or nothing, right? It's either you grow big and get acquired or IPO, or you fail. It really felt like that. And we didn't really want to have that kind of binary view of the business. In terms of thinking about gearing for exit, absolutely not. I mean, we never really started it with exit in mind. We did have a lot of people in the early days tell us, you need to pick a number and you need to get everybody sort of behind it, and so everybody works in the same direction and things like that. And we never really vibed with that idea. mostly because it felt arbitrary, right? Like that numbers, it could be 10 million, it could be 100 million, it could be a billion. It didn't matter because what we needed to do to get there was the same. What we were doing every day in terms of building the product, growing the business, selling it. It was just the same. And so we never really had that kind of idea of an exit. In terms of acquisition, we've always had interest. We always had interest right from the get go. I mean, we had interest before we even had revenue. We had like term sheets before we even had revenue, and the early ones were kind of easy to sort of reason through. I mean, we had that kind of traction in the early days, and you start to sometimes, we explored them a little bit just because of the novelty of it, really, at the time. But you start to sort of get to the point of I've only been doing this for like 6 months. That's a lot of money for 6 months work. You try to rationalize it that way, but we always came back to, I spoke to Shubs and we just ask ourselves a fundamental question. And that was, if this, goes to zero next year, would we regret not taking this deal? And, the answer was always no in those early days. But then what happens is, the offers get bigger and bigger as your business grows. And it starts to feel a lot more like you're putting a lot of money on black, basically, every time it gets larger. And the way that it kind of worked out for us is we never really thought of acquisition until somebody approached us. All our acquisition interest was inbound ultimately. And so, it was a kind of a distraction. And as soon as that was sort of, I would explore it, see if there was something there. It's like, no, it doesn't feel right. And then we just kind of, get on with business, so to speak. But, coming into 2024, we had a lot of inbound interest, and it was kind of at that level that felt a bit right for us. Again, we didn't have a number in mind, which in a way made it harder. Shubs and I are pretty modest people. If we were the kind of guys that wanted the private island and the yacht and the Lamborghinis, that would probably have made it easier because it would have put a dollar figure on it. But it just
guitars,
had to.
Michael.
Yeah, all the guitars. Yeah, exactly. I've got my problem with guitars. I don't have enough space for them. That's the issue. But not any other problem. Like I have too many or anything like that. But yeah, and it was really around what felt right. What really changed it was I was at RSA and I had a conversation with Zane, who's one of the co-founders of Signal Sciences, and they obviously sold to Fastly, and I asked him, like, how do you know, like, when's the right time to sell, or when does it make sense? How do you make that decision? And he said, you really have to think about it like the next phase of your company. And once he said that really kind of unlocked a different way of thinking about it for us. We were really thinking about it in a finite way, and thinking about, okay, well, we're cashing out, right? And so prior to that point, it's like, well, it felt like the end. And when you sort of recontextualize it, it helped with understanding and looking at these offers that were in front of us, and making the right decision. And because we weren't, one of the difficulties with making that decision is we really loved what we were doing. Assetnote was growing. Assetnote was in a really strong position, still is. And so it's a hard decision to make when it's like that. It's harder to sell when it's going well. And so that helped recontextualize it for us. And we had a bunch of offers, and we decided, hey, because we've got a bunch of offers we're selling, you can only really sell your company once. Let's hit up a banker and see what else is out there. And so we ended up with 5 LOIs that we had in the end, and we negotiated them all essentially into a similar space. But really, a core part of the decision, once the sort of the deal was in an okay state, was really around, what does the next phase look like, and how do we want to continue to grow Assetnote, and who would be the best fit for that, basically.
Yeah, it's always an interesting journey. I've probably had some different experiences in that. Often when starting a business, I sort of had a clear idea on who I might be selling to, and it wasn't the main driver for it, but I sort of tended to always have the exit in mind. Like, if I build this is who would be most likely to take it out. So it's interesting though, because it is the conversations you have, and it's probably from experience too, that you sort of go, if I do this, I just know that these are going to be the sort of people that are going to want to buy it, sort of thing. So I tended to often then make my business sort of, walk like the duck and quack like the duck, knowing that there was
Mm,
people wanting to buy a duck at the end of the process. So I think your approach is interesting in the way that it never really had a defined exit or knowing who was going to be that person to buy it. I think it sounds like it grew just a lot more organically, through that process. And it's interesting. I don't think there's any right or wrong either side. I think
mm.
the good thing with cyber is we're all trying to solve a problem, right? Or there is issues in the industry, and we see a gap or something we can try and fix. What other bits of advice now that you can sort of look back? Where did you get your best advice from? It was interesting, that conversation at RSA, but where else? Because you learn so much, don't you? Because you have to, right? When you're bootstrapping and you're going through this
Yeah.
process, you learn a lot. What other lessons would you say, if you were going to give us the top three that might be helpful to other people, that in hindsight now you realise were probably the best three that you'd pass on to someone else?
Yeah, it was interesting. When in the early days, we had a lot of advisors
Mm,
approach us, and the only, I guess, unique, commonality amongst all of those was that we didn't listen to any of it.
yep.
Um,
Well,
one
you
of the
listened
things
but
is
didn't
like
take it on board.
yeah, yeah. I mean, we came at it a little bit more from the point of view of we need to understand this ourselves. So Shubs and
Mm,
I, we're hackers, and so I actually have a strong feeling that hacking is entrepreneurial by nature, right? It's
yep.
all about solving problems. It's all
Mm,
about
pivoting.
adapting and learning quickly, right? And so
Mm,
so we just kind of took that approach in there, and so a lot of things that ended up being right in the end we didn't necessarily approach strategically. It'd be easy for me to turn around and say, "Oh yes, well I knew this from the start, and I'm
mm,
really smart," and all of that. But we kind of just figured it out as we go. I think one bit of advice that we received in the early days was really around everybody said, "Oh, you got to go to market with credit card signups and self service, and
mm.
it has to be less than $2,000 a year, like 1,999." They did that little trick,
Yeah,
and it's
yeah.
like we
That
looked
old
at it,
chestnut.
and there were two things. And again, like we didn't just take that sort of advice. We had a lot of people telling us, and so I guess the first bit of advice really was. Well, just to finish that story, we then we modeled it out. And we're like, this isn't financially viable for the product that we want to build. But then let's look at the market, and there
Mm,
weren't really any players. I mean, we pioneered this space in a lot of ways. The only sort of similar companies at the time were Risk IQ and Expanse. And we talked to people, and they were doing 400, 500K a year US, like annual deals. And we're
mm,
like, well, geez, I mean, if we came in at 380, we're the value option, right? So plus with all the additional capabilities that we had. So we kind of validated ourselves. And so the first bit of advice I would say, and this goes for, the thinking on bootstrapping, I'm not necessarily like anti VC, but one thing that I do,
mm,
see in founders, and that the bit of advice that I give is that you are in charge of your own business. It is, things like, VC, it's just a one, equity funding is just one way to fund your business. And
mm,
it is ultimately a business decision. Don't do anything just because other people are telling you that's the way it has to be done. They would point to Atlassian and say, oh yeah, well, look at what they do with credit card signups and all that kind of stuff. But it didn't make sense. We weren't Jira. We weren't selling Jira. We
mm.
weren't Atlassian. We
Yep.
were something else. And so don't just blindly take advice. It's your business. It's your ass on the line at the end of the day. So just because somebody says that you have to go get VC funding doesn't mean that's the only way. Just because a VC puts terms to you and say that it's standard doesn't mean that you can't negotiate it. And you just need to ultimately make decisions for yourself, because everything with the business is on you guys as the founders. All the momentum is created in the business, and all the risk and the ultimate success of failure, in my opinion, falls to the founders ultimately. So that'd be the first bit of advice. On a more practical level, I think what I was talking about earlier really helped us. Again, we didn't come at it from the point of view of let's get to market quickly and build it, because we would try and that's the mechanism for getting product market fit. The interesting thing with product market fit is we never use that term at Assetnote. We didn't.
Mm,
I think people overthink that, right? I think they come up with all this science and we got to do these surveys and we get this answer. It's like, for me, product market fit is simple. It's can you sell it, and can you sell more of it, and can you retain those customers at the end of the day? And that's a constantly evolving target, right? But it's still sort of the fundamental nature of it. We're very first principles in our approach to things. And so the idea that we would get this out to customers as soon as possible in a sale context, and get that feedback, and we iterate it so quickly. I mean, we'd do a demo. Shubs and I would get on a call straight after, and we would just pick it apart. What did they respond to? So not only were we refining the product, but also the messaging as well, and everything to do with the sales process. What went well. I mean, this demo just happened to go in this direction that really landed. Maybe we need to take the messaging and down that road a little bit more. And I mean, there were so many things that we learned through that process. But only because we were putting it out from a sale perspective, and not because we were over intellectualizing it and whatever. It was just about doing and getting out there because we kind of had to, being bootstrapped. So,
and you have
so
to
that's
do a lot of you have to do a lot of presentations. This thing too. I know when John and I were doing cyber aware, the more sales calls you can do back to back and all that sort of stuff, and exactly that, pick it out, and then where we're going now, we maybe need to choose the intervention. When we ask this question, we should be asking this one as well, because that uncovers if they know anything about that, which means we can go this way or that way. And if you want to replace yourself in business or make it successful and scale, you need to do that. The other thing is too, the retention of customers. There's no use being really good front end and being able to sell a customer, not being able to deliver and maintain. With new domain, I think it was highest in domain industry. We were the highest retention. It was up in the 80s, 90%, of renewal rates and stuff like that, because we made sure we service the shit out of the customer in between, doing it as well, to make sure that we were on top of stuff all the time, that we answered calls, got back to tickets, and did all that sort of stuff as well. Is there anything on that side that you could give as well? Because, once you've opened up the sales, that's one thing, isn't it? Maintaining the customer and actually making sure you can give everything that you said you would, plus some, is often where the challenge is, that over-promise, under-deliver sort of thing. What did you find in that part, or what lessons did you get on that side of the fence?
Yeah, I mean, it is an interesting balance to strike, especially in the early days. You're definitely selling a bit of roadmap in the early days. So you do have to be very smart about managing expectations. I think there was two things. First is the pace of building, right? You kind of build your way to product market fit, and so the faster you can iterate, the more responsive you can be to customer feedback. But I think ultimately it comes down to trust. I mean, we were going for 7 years, and I think we were at 5 years before we hired our first dedicated customer support resource. It was mostly done by myself, Shubs, and our customer success person. And so partly that's because the volume of support was low, but also because we had very high standards when it comes to things like customer success and customer support. I think ultimately, and this is true for I think any kind of security startup, is ultimately it comes down to trust, right? And what you're building over time, and you have to see it like a relationship. It's like you're building trust. You're solving real problems for them, and if you're thinking about where we're a partner in solving problems for these companies. I mean, when it comes to the mission, we got asked about, especially when we're going through the acquisition process, what's your mission and your values? And a lot of startups jump to like these really, lofty sounding things that sound good as a marketing soundbite. Oh, we're trying to secure the internet, or we're trying to, stop cyber criminals, and, all that kind of nonsense, protect society and all that kind of jazz. It's like, for us, no, it was more about, can we make the lives of our customers just more effective, more efficient, and maybe to some extent more enjoyable, ideally, right? And when you scope it down to that, it kind of focuses everything you do, both from the product's design and the engineering of that, but also things like how you treat customer support and customer success. And so we have very high retention. Partially it's because we build a product that shows ongoing value, and that was a key thing for us. The other thing is building a product that is designed to embed into existing workflows. Too many products are built as silos in the security space, and too many products are just kind of trying to be the dashboard, when really what you need to kind of do is embed in existing workflows, and it made us very sticky. We've got customers that build all kinds of stuff on top of our platform, even though the platform is self-contained and you can kind of just work with it. We're very open, and it was actually in the early days quite shocking to us that was somewhat uncommon in security products. People were charging, like we would say that, we'd talk about how we are API first in our development and everything in the product was programmatically accessible. And they would say, oh, well, how much is API access? And we'd be like, it's included, mate. Like, there's no, what are the limits on it? There's no limits on it, right? It's fine. And they were shocked with that. And we were kind of shocked that was the reaction, because things like that just made us way more sticky. It got us embedded into their day to day. And once you're embedded into their day to day, and if you're responsive to their feedback and you take that on board and you can iterate quickly in your development, then what happens is that creates a kind of, not only is it providing value, but from our perspective as a company, it creates this friction to switching, right? And it creates this cost, which means that if they're embedded in such a way, and like they've integrated with our API or even with our integrations out of the box, and we've got our certain amount of data and we've done all these things for them, a competing product needs to at least meet that bar, otherwise it's not going to be worth it, for them. And so that gives you an advantage in a lot of ways. So I would say, not thinking in terms of, obviously, the regular stuff around dealing with customers, building trust, being transparent, being upfront, and all that kind of stuff, helps obviously. But from a product design perspective, don't be a silo. At the end of the day, 90% of security is about the day-to-day doing, and not the crazy, lofty one-off breaches and things like that. And so if you can build your product to support that and work with that, you'll be a lot stickier in general.
And Michael, when the acquisition's happening, one thing I found is it sucks a lot of resource and a lot of time from the team as well. So often it takes your focus off the business for a bit because you've got so much process from a due diligence point of view and everything else. What did you find in that process? Did it have an impact on your business to a degree? Because you can't help but sort of take your eye off the ball of the business a bit when you're going through the process and being asked for so much from people looking to acquire you. So how did you find that balance, or how did you strike that while you were going through that process?
Yeah, it was interesting. I mean, that was something when we went into it that we were very conscious of. Ultimately, I felt we handled it very well, and it didn't have much impact on the business, but you certainly more on my sleep schedule. I think definitely, especially dealing with folks in different time zones. And so, but one of the things that can really suffer there is around this sort of thinking of, oh, we're going to get acquired, so like we should stop doing X, Y, Z, or like we can push that off. And I think that's obviously a massive trap in this, because ultimately the deal's not done until the deal's actually done, right? And there's a lot of things that can go wrong in that process, and it can, and in every case, it'll take longer than you expect it to take, for sure. So it is difficult. I think we have a small team at Assetnote, at the time of acquisition, but we have a very dedicated team. One thing that we didn't do, though, that kind of made it a little bit harder for us, is that we didn't tell the team until much later on, right? We didn't want them to be concerned. Often what can happen is they get concerned, oh, who are we going to sell to? Am I going to have a job? Are they going to, all these sort of things that they can, even if none of that is relevant, they can start thinking that. So we wanted to keep them, business as usual. So that helped in a big way. And, for me, when we started Assetnote, in terms of me becoming the CEO and Shubs becoming the CTO, it was really as simple as Shubs was a better hacker and coder than me, and somebody had to be the spreadsheet guy. So I drew the short straw on that one. And so in a lot of ways, Shubs definitely sort of picked up a lot of the more operational side on the product and other bits that I was doing. And that sort of freed me up to be a little bit more focused. We had great advisors, and supporters in the form of our lawyers and our accountants. Some of that, they were amazing, and that helped a lot. But it is very distracting, and that was sort of part of the reason why we hadn't really, even though we'd had a lot of acquisition discussions and people approaching us over the years, we hadn't really taken it, and we hadn't really proactively gone after it. There was this dissonance between, like, day to day, Shubs and I were just so involved in building and growing the business and executing on the strategy and the product, that this would be just such a dissonant idea. Like, it'd pull us out and remind us that, yeah, we're the shareholders of this business and we have to make decisions about that. And so we didn't actively seek it out, and it does become a distraction. But once we kind of shifted our thinking, like we mentioned earlier, and we got to the point where, like, let's take this seriously, we became a lot more focused on it, and it became more of something that we're able to balance. But yeah, it is a lot of work. It is very stressful. Every discussion, as even as innocuous as a discussion may be, is a negotiation. The due diligence is painful. Mostly because, not because like we had any issues or anything like that. It was actually a very simple and clean business, but just more like some of the third parties they bring in as, like, oh, we want to dive into the technical details, and Shubs and I'd be going like really deep, and these guys were just, some advisory consulting company that wanted to keep it up here. I'm like, all right, mate, well, we're on two different levels here. But ultimately it was pretty smooth. It was just a lot longer than we expected, and a lot of sleepless nights, just doing work. But we had, with our accountants and lawyers, we had a lot of preparation. Like, they had built it in such a way that it was easy for us to pull everything that we needed. We're internally at Assetnote, we're very big because we're a remote company from day dot, so we're very big on documenting everything. So all the technical detail on the products, all of that was already there. So there wasn't a lot of gaps that we had to fill in, and we'd run it very clean, so it wasn't too bad. But yeah, it certainly is a distraction. But at the end of the day, if you're going to go through that process, it's just something that you have to manage. It's just
You got to be
part of the
prepared for
deal.
it, though, don't you? That's something I think the first time that we went through it ourselves, and this is going back a fair bit too, was we weren't anywhere near prepared for the amount of detail I got to go through. And this is,
Mm,
back in mainly paper days, so we're
yeah.
opening, cardboard boxes up in cupboards in the back of the office for people to go through and stuff like that. It was I can imagine it being a bit better process, and I know from, newer ones or more recent ones, it is a lot easier. But also, it sounds like you guys have a good sort of yin and yang in the business as well, because
Mm,
often with especially cyber businesses, you tend to get two great nerd coders together that are good at doing the
mm.
code and building out something, but don't have the financial literacy, or they'll be missing the sales and marketing sort of piece of the puzzle, and those really important bits. So again, just sort of for the other, it sounds like you guys had a really good sort of blend.
Yeah,
But
definitely. Yeah.
how do you sort of give advice now, and what gaps did you need to fill that you sort of found as you went along, that you sort of talked about a sales success person before and other things, but where was it, or what was the right time to sort of bring in the people to fill the gaps or take off your plate what really needed to do to free up to do the real important stuff for you guys?
Yeah, certainly. I mean, I think, thinking about how Shubs and I fit together, in hindsight, you could consider us lucky. We didn't really think about that too much going in. I mean, I'd known Shubs for years, just as part of the community. We first met in like 2014, I think. Sometime around that, I was doing iOS applications security research presentation at CrikeyCon here in Brisbane. He was doing voicemail hacking. He's like, "Oh, let me show you this technique," and we just kind of were around the scene. But I hadn't worked with Shubs prior to Assetnote. And so we kind of got fortunate that we were very compatible. I think the biggest thing that we've reflected on is that there was a real lack of ego, right? We have, one thing that we see in founders, they'll come and ask us and they'll say, "Oh, well, what do we think of the founder split? I'm doing this role, or they're just doing this, or whatever. And the answer is always the same. If you're not comfortable with an equal split with your co-founder or co-founders, then they're probably not the right people for you to start a business with. At the end of the day, everything was equal. There was no ego. It wasn't, even though we kind of understood that, on the business side and the product side, that I had the final say, and on the technical side he had the final say. We never really ran it like that. The thinking was that, if I couldn't convince Shubs that something was a good idea, then maybe it wasn't a good idea, and vice versa, right? And so we kind of just ran everything very equal, which a lot of people say doesn't work, but it worked for us. And partly that was because none of us had the ego. None of us had like, well, my idea is right because it's right. It was always like, what is the best way forward? Let's figure it out together. And, we'd have disagreements, but it would always be productive because it would always be centered on, let's get a resolution here, right? And so that was one. In terms of the experience,
sounds like a good marriage.
Yeah. It probably was. To think about, I certainly probably in some years at Assetnote spent more time with Shubs than I did with my wife, and especially in the early days. But yeah, no, it was definitely it has an element of that. You have to really kind of trust the other person and be able to kind of set your ego aside and just work on something together in a genuine way. We're like at Assetnote as well. That flows down into the culture. We're very direct, but not in a blame way. And I think that's the key to making it work. It's like, it's always a very pragmatic way. That's another sort of saying that we have at Assetnote is, for us, it's all about ruthless pragmatism. And I think that's a quality that Shubs and I have that made it work, right? Because it's not about everything that surrounds it. It's about what we're actually trying to achieve and what we're trying to do. And it was easy to bring it back and focus it. In terms of the skill sets, it's an interesting one. Shubs and I were very different when we started the company. He's 11 years my junior, right? So he was in his early 20s, single. I was married with 2 kids at the time, and 2 mortgages, right? So it was kind of a very different situation. And in a lot of ways, I look back and I'd be like, oh man, imagine if I had done this when I was his age, right? Like that would be amazing. But a lot of the skills and experiences that I had were very relevant for Assetnote, and certainly filled a lot of gaps that Shubs had on that side. So, for example, I started at Big Four in my career, and one of the things they pushed me to do, and not a lot of people know this, was to do the CA, right, Chartered Accounting. Even though I was doing pen testing and technical stuff, which was really challenging for me at the time, and certainly there was like lots of nights where I was like, "Why the hell am I doing this? I'm not going to be an accountant." But a lot of what I learned there flowed through. Once I got into working at Spider Labs, I was doing a lot more work with sales, and I got a lot more. Even though I wasn't a salesperson, I was working directly with them. I got a lot more understanding around how enterprises buy security products, sales processes, incentives, all that kind of stuff that was valuable, again, bringing into Assetnote. And then certainly, as I mentioned on Shubs' side, he's just like an insane hacker. Like the way that he thinks about stuff, in terms of applying security at scale and really pragmatic research, is just like, miles beyond me, right? But like miles beyond most people in the security space. And so like it really worked well together. In terms of growing the team, it was kind of interesting. We at the time of acquisition, we had, I think, 16 people, including myself and Shubs. So we kept it very lean. And a lot of people would be surprised when we're talking to them, and they'd be like, "Oh, what's your revenue?" And we tell them our revenue, and we'd rattle off our customer list and all these big names around the world. And then they'd say, how many people on your team? And we'd say like 15, 16 people. And they would be shocked, almost like, especially for the finance guys, they were like, they couldn't compute that was even possible.
What, 15?
Yeah, exactly. And so, but for the longest time at Assetnote, we were 5 people, including Shubs and myself, like for the first essentially 4 years of the company. And it was really in the last few years that we started to grow out. And the way that we did is, like many startups, right? You wear a lot of hats. And then as soon as it becomes necessary that we need to offload a hat, that's when we sort of look to hire. We certainly stretch things. We're very lean, so we certainly stretch things, and that was not just Shubs and I, putting in a lot of work and doing a lot of the day to day, and really understanding the breadth of the business, but also the team. I mean, we hired some great people. We've got an amazing team, and they really have that same sort of really driven, very pragmatic kind of attitude. So it didn't matter. Like, there was none of this, oh, that's not my job kind of thing, or that everybody was just like, we just got to do what we got to do, and I think that helped us stay lean. So it's not just Shubs and I; it's definitely the quality of the team, and we did take a lot of time with hiring. We were very particular with hiring to find those kinds of people. And we didn't necessarily look for, oh, you were such and such at some large organization and you have X number of years experience. It was really much, looking for that kind of personality and that kind of attitude. And I think, for a startup, that's really important. And, ultimately, when we came to sell, and when we spoke about like the due diligence, and what was kind of interesting about that was because Shubs and I, because we'd run such a small team, Shubs and I were very involved in all aspects of the business across the board, and that was something that people noted was they don't meet a lot of founders who have that kind of really extensive understanding of all these aspects of the business. But that was just because of the way that we ran it. We were kind of, lean. You could probably argue that we were in some cases tight asses, but that I think ultimately it worked for us. But yeah, that was how we were able to make it work, and we probably focused predominantly on technical skill sets in terms of growing the team. The vast majority of the team was more in that engineering, product, security, research, DevOps kind of space. And it was a little bit slower when it came to the other sides of the business, but because of we were very product led in the way that we thought about go to market. I mean, we didn't really do outbound sales. Everybody came to us, and that was another thing people were surprised of. It was a lot of word of mouth and a lot of referrals, and that really came down to the strength of the product. And so everything that we did, our messaging, our the minimal marketing that we did was really centered on the product and was product first. And so that, I think, gave us a lot of leverage on the sales side, that we didn't necessarily need to have like gigantic teams of LDRs and sort of big outbound function. And even from a marketing perspective, we were able to get a lot of leverage from what we had.
And just on the other side, and I'll let Tom jump in after this, but just to sort of pick it up on the other side, and so people know, because usually with businesses that I've sold in the past, there's often an escrow, or there's some sort of tie back to the business in some way, shape, or form on the other side of the fence. Again, probably advice, lessons, and what that sort of looks like for you guys sort of going forward, because sometimes there'll be on the other side. I've often been 24 months tied up to a business after a sale. Some you hand over keys, everything, and you basically step aside, and it's no more care, no responsibility. What's that look like for you as a team, and then and what sort of the future hold for you now? Whether with this or with what are the plans going forward over the next year or two?
Yeah. So in terms of our deal, and this was the same for all the LOIs that we had, we didn't actually have any earnouts or restraints in that way. It was, all the deals were majority cash or all cash. And really the way that we approached it, and again, it also depends on the nature of your business. We're very highly profitable, successful business. So that gave us a bit of negotiating power in a way, because we could always say, well, we're fine, guys,
Yeah, we'll keep the
and
money.
so, yeah, exactly. And so, how we looked at it, and again, I think this is a way that a lot of founders don't really approach it or think about it. It's really around a risk based model, right? And so if you think about the common elements of a deal, the upfront cash is the least risky to us as the seller, and the most risky to the buyer. You want to maximize that if you're the seller. From there it starts to get a little bit murky, like with say, debt, right? Seller's notes, things like that. It's still cash, so the value's kind of clear, right? But it's a bit more risky because it's debt, often subordinate debt, and things like that. And so you want to balance that. And then you start to get into, equity and earnouts. And depending on the kind of company, if it's a public company, maybe maybe there's less risk around like the value and the liquidity of the equity, any equity role component. Certainly for a private company, there's a big question mark on when that will be liquid, and certainly when what the value would be, right? It's not really in your hands. And to us, like, way down the list is any kind of earnouts, right? It doesn't make sense to us. We never made sense to us to have an earnout, and we just pushed back against it, and everybody was kind of fine with it ultimately. But so our deal is very clean. There's nothing related to the deal that's keeping us, at Searchlight, right?
Yep.
Really, it comes down to for Shubs and I. Again, what we were talking about earlier around this is the second phase, right? One of the things, for us, we think in principles. And so when it comes to structuring the deal terms, for us, it was like, we want to get an agreed value for Assetnote, right? And so for us, it was around value certainty in terms of how we structured it. Because one of the things that we would regret is if we sold and we said we're going to sell for this amount, we'd regret not getting that amount versus losing upside, right? On a subsequent thing. So that was a core focus for us. But once those sort of deal terms were kind of set, and they were all kind of similar, and obviously you have to negotiate the fine print as you're going through and drafting the definitive, right? But for us, it was around, like, the other thing is, like, we didn't want Assetnote to die. For us, we loved what we were doing. There's still so much more that we want to achieve here, and looking at what we can do together was kind of interesting for us, and that was a big part of it. Surprisingly, I mean, we had a lot of very large companies as in those LOIs, and much larger than Searchlight is. But we some of them even had ASM, right? We were bigger as a standalone business than their entire ASM business. So it was very much like, you're going to be off down in the corner, and like 10 layers below management. And what are we really going to achieve? How are we going to really integrate with some, and capitalize on some of the interesting technology and ideas that they have in their existing products, and bring that into Assetnote and vice versa. And so that was a real big part of it. And so, so when it comes to Searchlight, even though there's nothing in the deal keeping us, there's plenty that we're excited about in terms of the direction of the product. The other thing as well, Searchlight's a UK company, 2 founders as well, sort of very similar to us, and culturally, really, really closely aligned. And that was especially the founders, and we got along very well with the founders. And so I think, all of that is sort of what's keeping us here. So for the foreseeable future, it's definitely, growing out, what we're doing with Assetnote, but in the larger context of the other products at Searchlight. So I'm the chief product officer at Searchlight. So it's not just Assetnote. I have their products as well. And so there's a bunch of interesting stuff that we're doing to utilize all of the interesting data and techniques that they have in those other products. And so that part is exciting. In terms of long term, like, who knows, right? Obviously, Searchlight is owned by private equity, so my guess is, they'll probably expect to sell it, as private equity does, right? So they'll, that'll shift in the future. I guess ultimately what it comes down to when people ask that question is, like, would we go again? And I think you're going back to what you mentioned earlier, Jason, is really how we think of it. It's like, I wouldn't start a company for the sake of starting a company. We didn't do that for Assetnote. We were in the need. We had sort of seen it, and it kind of grew naturally from there. And I think, for Shubs and I, certainly, that would need to be the case, I think, if we were to do something again. And that's just, for me, is being involved, working with customers, doing research, understanding the market, looking at new technologies. Security doesn't exist in a vacuum. It's a product or reflective of the larger trends in IT, and that's what worked for Assetnote. Like, we understood that, and we got there, at the time that these trends were kind of converging, and I think that's always the case. And so just being in it is kind of potentially will lead to something else. But again, like, we're not really thinking about it, just like we didn't think about Assetnote with the exit in mind. We just kind of more day-to-day kind of people, and so for the foreseeable future, it's continuing to grow Assetnote and working within the Searchlight company, and we'll see where we go from there, basically.
I just want to say, Michael, that was fantastic. Thank you so much for sharing that story. There's so many lessons in there on that entrepreneurial journey, and it's like it's hard stuff to go and find to actually kind of get those concrete, those tangible, those kind of sticky ideas and those lessons you've learned. So, look, we've gone over time. It's been a fantastic conversation. And listeners, if you want to reach out, you can find Michael on LinkedIn. You can jump onto the Assetnote website, Searchlight, learn more about them. But thank you so much for your time, Michael, and sharing those stories. Thank you, as always, Jason. It's fantastic to hear two successful entrepreneurs kind of go back and forwards and mine these lessons out as well. So thank you both.
Thanks guys. Thanks for having me. It's a great discussion.
Thank you, mate.